Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's February 2025. This video will discuss how the potential to go back to higher rising inflation is probably the most important risk to the U.S. stock market and what we can learn about that risk from the bond market. The U.S. Federal Reserve began easing monetary policy last September. At the time, year-over-year U.S. consumer price inflation had fallen to 2.5%, and it looked like inflation was on its way back to the Fed's long-term target of 2%. But since then, inflation expectations have edged up again. Usually, when short-term rates, the blue line here, are falling, long-term rates, shown in green, are also falling. But instead, 10-year Treasury yields have been rising steadily since last September. These higher yields provide investors with a cushion in case inflation rebounds, as well as a margin of safety to compensate for the impact of likely continuing large federal budget deficit. In this chart, the lower line is the yield on 10-year inflation-protected securities, or TIPS. Investors in TIPS obtain that yield plus whatever inflation occurs while the bond is held. The upper line is the yield on nominal 10-year Treasury bonds. Investors in TIPS and investors in nominal bonds are taking the same credit risk, have the same maturity, and for them to end up with the same return, the actual amount of inflation over the next 10 years needs to be that green shaded area, the difference between the two lines. That is the expectation of inflation as derived by bond prices, also known as the inflation break-even. This chart shows on its own the green part of the prior chart, the inflation expectation derived from bond prices. We can see that the 10-year inflation expectation at 2.4% is higher than usual, but not yet alarming. On the right side, we can also see that it has been ticking up in recent months. Inflation has a more powerful impact on stock market outcomes than any other factor we have examined. Let's look at the evidence since 1945. On average, the S&P 500 has delivered a return which has been 7.2% per year higher than inflation. But at the times that inflation was over 3% and rising, the return on US stocks was 5% below inflation. Whereas when inflation was not over 3% and rising, the annual return was 12.4% higher than inflation. Because this difference is so large, US stock market investors should care deeply about what happens next with inflation. So could inflation get back to that danger state for stocks where it's 3% and rising? Well, it looks that way. This slide shows charts of 4 other inflation metrics. The inflation expectations from the University of Michigan survey, the inflation expectations derived from 2-year bond prices, the percent of small businesses planning price increases, and the Bloomberg Commodity Index. For each of these series, the implied level of inflation has been rising in recent months. So, to summarize, one way to measure inflation expectations is to observe the difference between the yields on nominal bonds and inflation-protected bonds. These expectations and other information that we shared suggest that inflation could be rebounding. If a rebound occurs, that would pose a challenge to the bull market in U.S. stocks. At Atlas Capital, we currently remain at full equity weight for our clients, but we are watching these inflation developments closely. Thank you for listening. To get other recent market commentary, be sure to watch the market commentary playlist on this channel. And don't forget to subscribe to get notified as soon as the latest is posted. You may also visit our website at atlasca.com to have access to our investment philosophy and market views. Thank you.